Depending on where you get your financial news, the de-dollarization story is either the most important geopolitical shift of our lifetime or an overblown narrative that misunderstands how global finance actually works. Today, I want to cut through both of those positions and look at what the data actually shows, because the truth, as it usually is more complicated than either headline. And understanding that complexity matters, because it changes how you think about the dollar, about inflation, and about the long-term stability of the system your wealth operates in. De-dollarization refers to the process by which countries and institutions reduce their reliance on the US dollar in international trade, foreign exchange reserves, and cross-border transactions. The dollar became the world's dominant reserve currency after the Bretton Woods Agreement in 1944. And that status has given the United States an extraordinary privilege: the ability to borrow in its own currency, to run persistent trade deficits, and to impose financial sanctions with devastating effect. The question being asked with increasing urgency is that privilege beginning to erode? And if so, how fast, how far, and what are the consequences? What the data shows: the bearish case for the dollar. The dollar's share of global foreign exchange reserves has declined from around 70% in 2000 to roughly 58% today. That's a meaningful shift over 2 decades. China and Russia have significantly reduced their treasury holdings. Saudi Arabia has begun accepting payment for oil in currencies other than the dollar in some transactions. The BRICS bloc has made explicit its intention to develop alternative payment infrastructure. And central banks globally are buying gold at the fastest pace in over 50 years. A behavior that, at institutional scale, represents a hedge against dollar dependency. What the data shows: the bullish case for the dollar. Despite that decline, 58% is still an extraordinary share for a single currency. The euro, the next largest, sits at around 20%. Dollar-denominated debt is still the global standard. The SWIFT system, despite alternatives being developed, still processes the vast majority of international transactions. And critically, there is no ready replacement. The yuan is not freely convertible. The euro has structural fragilities. The BRICS currency proposal remains aspirational at best. The honest synthesis: de-dollarization is real and directional, but it is slow, structural, and decades-long in its full implications. It is not a collapse event, it is an erosion. And erosion, compounded over time, can be just as consequential. For the average person, the most practical implication of gradual de-dollarization is inflationary pressure. If global demand for dollars slowly declines, if fewer countries need to hold large dollar reserves to participate in international trade, then there is less structural demand to absorb the dollars the US government is continuously creating. Less demand for a currency, all else being equal, means each unit is worth less. That means higher prices for imported goods. It means the purchasing power of dollar savings erodes faster. This is not a prediction of imminent collapse. It is a directional pressure that, combined with the debt dynamics we covered in the last video, creates a compounding headwind for the dollar over the coming decade. The assets that historically perform well in this environment, gold, real assets, commodities priced in dollars, are not coincidentally the same assets central banks are currently accumulating. That alignment is worth paying attention to. Next week, I'm going deep on inflation, specifically why it has been stickier than the Federal Reserve predicted, and what the historical parallels tell us about where it goes from here. Subscribe so you don't miss it. And if this analysis is changing how you think about your trading, Capital Collapse is the channel for the practical side of that. Link in the description. See you next week.